Welcome to lesson 4, part B. We're going to discuss the normalization of the outcome of the bootstrapping presented in the previous video. That is relevant with respect to the transaction costs. First of all, let me clarify something related to the bootstrapping role. Some scholars advocate for the use of the Monte Carlo permutation test as a replacement for the bootstrapping. For a thorough coverage of the Monte Carlo permutation test, it is possible to refer to this David Aronson's famous textbook. Anyway, the Monte Carlo permutation test is also able to simulate different test sets as well as the bootstrapping, but it just tells us whether the model is significant, which means whether its expected return is significantly bigger than 0. We don't need this Monte Carlo permutation contribution here, because we already conducted statistical tests, namely t-tests. Recall that from lesson 2. The focus here is different. We want to measure how sensitive the model performance is to sample variability, and it is just the bootstrapping which can answer this question. By the way, as regards the trending, which is also recommended as a prerequisite for the tests described in the Aronson's book, we complied with it, adopting the two-sample t-test discussed in lesson 2, part B. That said, going for the bootstrapping is more than appropriate. Now we can get deeper into it. Remember first that all the performance estimates included in the MASASP outcomes are gross estimates. There is a valid reason for that. Transaction costs are handled as netting factors, which will be the topic of lesson 5. Well, that said, the lower confidence limit returned by the bootstrapping has a further value as it can be compared against the transaction cost. The transaction cost is then referred to as the lower bound, indicated with LB, meaning that the lower confidence limit should not stand below this value. The optimum is to have a lower confidence limit 1 order of magnitude higher than the transaction cost, or let's say 5 times bigger. So if the cost is 3 basis points, we go for a lower limit of the expectancy of 30 basis points, or at least 15 basis points. Now, things get a bit complicated by the fact that the expectancy is not only a gross return, but it may also refer to different notional values, as the position size is scaled according to the ensemble model logic. Recall lesson 1 to this regard. We need to switch from raw estimates to normalized estimates. First, let me explain why notional value matters. The transaction cost entails 2 cost components. The brokerage fee. This is the smallest cost item and can be assimilated to a fixed cost. Let it be $5 per trade, for instance. Then we have the second cost item, the bid-ask spread. That is the biggest cost item and is a variable cost in that it is proportional to the notional value. It could be 3 basis points, for instance, meaning 0.03% of the notional value. Let's make a full-featured example. If we have an equity of $300,000 and we submit a trade with the full size, with notional value equal to the equity, we wind up bearing a transaction cost of $305. If we instead submit a trade with a position size of 0.7, with a notional value equal to 70% of the equity, we wind up bearing a transaction cost of $215. The normalization process takes that into account by considering all trades as if they were full-size trades. This adjustment returns an expectancy value which can be compared against the transaction cost in basis points. Besides the raw expectancy distribution, the blue one, we have an additional wrapper which refers to the normalized expectancy distribution. As position sizes are always smaller than 1 or equal to 1, these normalized estimates will always be bigger than the raw estimate. Looking at the raw estimates then would be penalizing. Let's go for a real-life example. Let's have a look at the conservative long strategy on gold. The expectancy point estimate is nearly 60 basis points, the vertical green line. Its lower confidence limit is nearly 17 basis points. Look, that is the downgrade. The bottom of the chart has a caption which reads normalized estimates. Let's switch to another real-life example. Here we have the long strategy on the US stock index. The expectancy point estimate is nearly 65 basis points. Its lower confidence limit is nearly 34 basis points. The downgrade of this system is definitely smaller than that of the previous one. Then this system is told to be less sensitive than the previous. Then it's said to be more robust. Remember that we are talking about robustness to sample variability. Let's have a look at the greedy strategy on gold. The short strategy on gold was already presented in the previous video. The point estimate of the expectancy is nearly 67 basis points. The lower confidence limit of the expectancy is 23 basis points. The downgrade of this system is a bit bigger than that of the previous one. This system is told to be more sensitive than the previous, then it's said to be less robust. Of course, these comparisons are based on normalized estimates. We can then rank our systems in terms of sensitivity. The less sensitive, the better. The least sensitive system comes first. We can describe them also in terms of robustness, which is the inverse of sensitivity. Well, let me remark though that it is not said that a system which is less robust with regard to sample variability could not be better in other terms, for instance, in terms of other risk metrics, in terms of volatility, or shorter drawdown periods, or smaller sensitivity to other factors. Besides, the conservative long strategy on gold comes second in this ranking, but it ranks first in terms of point estimate of expectancy. It attains a 70 basis points return per trade on average, and that is a reliable out-of-sample estimate. Ranking is a troublesome matter. What matters here is not to rank the systems, but rather to check whether each system is viable, meaning that the lower confidence limit of its expectancy is definitely bigger than the transaction costs. In the next lesson, we are going to dive into the transaction cost issue, taking account of slippage and market depth. Thanks for watching, and see you at lesson 5.